Thank you so much for joining us this morning during Financial Inclusion Week, which is a fantastic global initiative to promote financial wellness and well-being across the world. I'm Vinita Godino, the CEO of Financial Resilience Australia and the co-founder, along with my wonderful companion, Anna Perera-Shaw, of the APAC Financial Wellness Initiative. Before we start, I'd like to acknowledge that I'm coming to you today from the lands of the Wurundjeri people of the Kulin Nation, and I pay my respects to their elders, past, present, and emerging. So today is a really exciting conversation that we're going to have with Anna Perera-Shaw about three of the topics which I'm absolutely passionate about: financial capability, financial confidence, and financial well-being. Financial capability, of course, is the ability to make confident decisions about money. Financial confidence is about having the belief in your own ability to make a difference to your financial future. And financial well-being, of course, is the outcome that we all look forward to by managing our money. So without further ado, I'll hand over to Anna for a wonderful evidence-based discussion.
Thanks very much, Benita. So I'll share my screen and get us started with the presentation today. I guess the thing to start with is thinking about the current landscape that we're in, and we know that it is a climate of uncertainty. There is a lot happening in Australia. For those of us who are dialing into this session who aren't in Australia, there's the cost of living it's going up, grocery prices are becoming more expensive, petrol prices are going up. There's a lot of financial stress, and we can't escape the fact that we've just been in a global pandemic, which, it hasn't ended yet. We can't really say it's the end of it yet, but we are outside of the peak of this. But instead of seeing an environment that is less stressful, we're seeing increased levels of stress, particularly among customers who hold debt products, particularly home loans. And home loans are a product that customers still want to have. There's a lot of conversations about whether young people actually want to own property, but in Australia, there is still very much the Australian dream of owning one's own home. And it's something that there are aspirations for, and there is opportunity to help support customers in actually getting these, meeting these goals and buying properties and, feeling that they can do this and manage their expenses to get there. To give a bit of background into RFI Global, which is the company that I am Director of Consumer Credit Deposits and Payments for. We're a global market research firm that specialises in financial services, and we're active in 48 international markets. So I'm based in Sydney, so I'll be sharing some research from our Australian research programs, looking at transactions research, savings research, and mortgages research. So these are nationally representative surveys that are run on an ongoing basis. So at any one point of time, there's always a survey that's going on in field, and we're always asking questions. How are you feeling about your finances? What are you doing to address financial stress? How are you managing your products? What are you trying to, what goals are you trying to meet? And how can your bank and financial institutions support you better? So using this data, I'll share with you some information about the current landscape, particularly thinking about financial wellness, but also what customers are concerned about in this environment where we're seeing stress and uncertainty and just levels of customer confidence shifting as customers try and work out what their options are in this market. So Vinita did set the context for financial capability and financial wellness, and according to the RFI Global data set, what participants let us know, or what respondents tell us, is that financial wellness incorporates a feeling of financial stability and readiness to handle unexpected expenses. And on this slide, you can see a number of quotes from customers and from consumers in Australia. And there's a sentiment here around financial stability being, if I feel that I can cover my expenses, if I know that I'm financially secure, if I feel in control of my finances, then I feel that I'm at an optimal level of financial wellness. Comfort as well, just feeling like I can live a comfortable life. Maybe I don't need I don't need luxury, but I just need to know that I can meet my expenses. I feel comfortable. I have enough money to live the life that I want to, rather than being really focused on necessities. Also, a readiness for unexpected expenses. And this is something that I'll touch on a little bit later in terms of the importance of a financial buffer being something that we really learnt in the pandemic, where customers lost their job. And, this might have been in roles where they never expected to have any kind of economic uncertainty or risk of losing their job, as to what we saw in the last few years, where customers were told that they just didn't have a job anymore without much notice at all. So having that financial buffer being one of the other key components of financial wellness. So if something happens, they know they can cover it. There's also elements of financial knowledge, financial independence. I think financial independence is particularly important when we think about women and what they need, and feeling that they aren't dependent on a partner, or not feeling trapped in a relationship because their finances are controlled by someone else. So knowing that I have the ability to leave if I need to, or make my own decisions, or have my own money to make my own, make decisions that impact myself or my family independently without being dependent on others, but also, being free from debt coming out in some of these quotes as well. So of course, there's a few different components, and it depends on the person in terms of, for them, what does it mean to be at this optimal level? But really that idea of stability and comfort and readiness for unexpected expenses comes out quite strongly. However, when we actually look at what proportion of Australians indicate they're at an optimal level, it's around 1 in 3. So if I draw your attention to the right-hand side here, you can see 32% of consumers say they strongly agree they're at an optimal level of financial wellness. There's an additional 26% saying they agree. So, half the market there saying that they're at least at a somewhat agree or strongly agree they're at an optimal level. But if you flip the perspective and you look at the orange, which is the strongly disagree or the disagree, there is still close to 20% in the market saying they disagree with this statement. You can see for younger customers as well, there is a higher proportion of disagreement with this statement. There's an element that life stage, how much savings they have, how many dependents they have, the situation they're in and the goals they have. But it seems that across the age groups, basically for all age groups, below 55, they really have a higher proportion saying they disagree with this statement. There's also an element of income, and I think we need to be careful when we talk about financial wellness that we don't go, the more money you have, the more you're financially well, because we just know that's not true. You can have double the income of someone else, but you could have debt, you could be financially stressed, you could have more responsibilities or more dependence, and it's not enough to think that financial wellness depends solely on income, but on the other side, there is still a relationship. So customers with a lower income are more likely to disagree that they're at an optimal level of financial wellness. It does make it harder to save for those unexpected expenses or meet bills or manage money. And we'll see that later on in a few slides' time as well. But worth considering that although it's not the solution, having more money doesn't necessarily help you be at an optimal level of financial wellness. There is still a relationship where we see those lower income customers more likely to say they disagree that they're at that optimal level, and a higher portion of agreement for those in that slightly more affluent group there. The other thing is, when thinking about the market that I mentioned, in Australia, consumer optimism is impacted by a range of factors, including the global environment. And we have seen this level of optimism has fallen over the course of 2022. And this is a data point from the Westpac Melbourne Institute, their Consumer Sentiment Index. And we saw that over the years, it's remained fairly consistent around that 100 index point, so that red line, and it did fall dramatically in that early part of the pandemic, which we hadn't seen it fall that much since the GFC or even before that. And then there was some recovery. We really started to see that recovery in the end of 2020 and early 2021, but then since then we've just seen it fall. So every month since mid-2021, that optimism level or that sentiment has been dropping, and the cash rate continuing to drop has been definitely playing a role. There's been inflation as well, the war in Ukraine, flooding, all kinds of components, including COVID as well. Last year we did see that there was still difficulties getting the vaccine, and difficulties in movement restrictions, and people just getting sick with COVID, having much higher case numbers. But this is just really reinforcing that consumer sentiment is really sensitive, and it's really influenced by factors in the market, not just what's happening in Australia, but globally, political uncertainty, global uncertainty as well. And the point about the cash rate is also something that is very front of mind in the Australian market at the moment. So this is something that consumers are aware of, they are thinking about it, and it affects different groups in different ways. So to set the scene a little bit, on the left-hand side, we've got a chart here looking at how do customers expect the cash rate increase to impact their financial position. And there is a split between those who think that it will have a positive impact on them versus a negative impact on them. And it makes sense. If you have a mortgage, it's more likely to affect you negatively because your home loan rate will go up. If you have savings products, it's positive for you because the rate on your savings products goes up. And in very low rate environment. For the last few years, we've seen very low savings rates. So if you're trying to save money in a savings account, it's actually really difficult to build that up because rates got to about less than 0.5. It was just not that easy to save money in those types of traditional savings products. And there was increasing consideration of things like cryptocurrency or other forms of investment because people were just looking to see how can they maximize their money, how can they actually boost their savings, because traditional banking products just didn't seem to really be cutting it. But now we've seen that shift. So as the cash rate's been increasing, there is opportunity for some customers to have a positive outcome, others more concerned that it will be negative. And on the right-hand side, you can see for 35 to 54-year-olds, they're a lot more likely to say that they expect the cash rate increase will impact their position negatively. And this is a key demographic or age group for mortgage holding. We know this is the average age or average age groups who hold a mortgage. Average loan term will be 25 to 30 years. So between this group, for a lot of them with a home loan, in Australia, it's about 1 in 3 Australians have a home loan. And we know that it's a product customers hold for a considerably long amount of time, especially if they end up refinancing and extending that loan term. But that perception that the cash rate will impact their position negatively, particularly prevalent for the 35 to 54-year-olds. The interesting point here is just really that for mortgage holders, they're a lot more likely to say that the cash rate rise will have a negative impact on them. For those with a term deposit, which traditionally has a higher rate than a traditional savings product, they're more likely to say that it will have a positive impact on them. So just reinforcing the point I made about the fact that if you have that debt product, more likely to expect that it will harm you or be negative. Whereas if you've got a savings product, it's more likely to be something you think could actually be quite beneficial for you. The other point is how concerned are Australians about different things happening or different market factors. So the first one that really stands out, of course, is this first option where we see 1 in 2 Australians indicating they are extremely concerned about inflation and the rising cost of living, making it harder to afford daily expenses. And we don't often see really high proportions of people indicating the 8+ out of 10. So just reinforcing that is quite a high result. And if you add together the 6 to 7s, the somewhat concerned, you get nearly 3 in 4 customers saying that they are at least somewhat concerned about inflation and the rising cost of living. And also close to 1 in 3 saying they're extremely concerned about not being able to make ends meet. So there is concern about general affordability, and it's not just managing a lifestyle, it's actually meeting the basic necessities as well. And you can imagine that this is different in different regions of Australia. I mean, we're looking at a national view here, but if you were to look at the data for metropolitan areas versus regional or rural areas, you would see a bit of a difference in the level of concern as well, particularly when thinking about, in remote communities. We know that groceries are already unbelievably more expensive than metropolitan cities. So to increase that even more is, having profound impacts on those communities. So at the national level, we see very high levels. And if we look at this by age as well, you can see that younger customers in particular are more likely to say they're extremely concerned about not being able to make ends meet, concerned about rising rates, concerned about the ability for them to buy property. And I started the presentation mentioning the fact that it is still an aspiration of Australians to own their own home. And there is growing concern about the ability of customers to actually be able to do this as it gets more expensive. Although property prices are falling, the ability to afford the property and save the money is becoming more challenging. So it's kind of this interesting challenge where the aspiration is still there, but there's falling confidence in the ability to actually be successful with that goal. And I guess the other thing, I've been speaking about necessities rather than luxuries, but there is still concerns that people won't be able to afford luxuries like going on holiday. And this isn't an essential, but it's still things that customers look forward to, plan for, something that pre-COVID was, for many customers, they liked to save money and do a trip, particularly younger customers who potentially before they settle down or before, if they're looking to have a family, maybe before they do that, they want to travel a little bit. Not being able to afford luxuries like going on holiday is something they're also concerned about, and something that, customers are first to cut when they think about how can they save money. In terms of strategies for saving money, as I just mentioned, a lot of it is reducing spend and non-essential purchases. So the first option here, looking at generally making an effort to save more just in case. So just saving as much as they can really, but also reducing spending of non-essential items or delaying large purchases to save money. So thinking about maybe something's broken in your house and you just think, okay, well, I don't need to do this immediately. How long can I put this off before it becomes an issue? And the orange is the cohort of customers who are concerned about their financial position. So we can see across all of these options, those who are concerned are more likely to be taking a number of these actions, such as looking for cheaper utilities, reducing spend, even things like cancelling subscriptions, supplementing income through additional casual work. There's been a lot of conversations recently about, are customers increasingly considering driving Ubers or taking up extra jobs, or having their own small business, trying to get extra money in the door, just given it's been quite difficult either for some industries for people to get back into work, or customers just looking to see how can I bring more money in, what can I possibly do to increase my financial position. And then the other thing, as I mentioned, with trying to increase the savings balance, something we've been tracking since pre-COVID as well is, are customers intending to change their savings behaviour? And we've seen a continuous increase in customers saying they're planning to increase the amount they deposit into their savings. So there is a conscious effort to boost that savings balance. Even when we saw a low rate environment, customers were still trying to save their money, and they're less likely to say they're not planning to do anything. We saw a bit of an inclination to invest money into higher returning asset classes, such as cryptocurrency, but that has stabilized a little bit as the traditional savings products become a little bit more competitive and the rates get a little bit better. Customers may fall back on those less risky options, particularly in that climate of financial uncertainty. But it is interesting that customers are continuing to just, at a baseline level, try and save their money where they can and just boost that savings balance as much as possible. And I have mentioned mortgage holders, and I think it's a cohort that's worth spending a couple of minutes on, just thinking about the concerns they're experiencing and the growing rates of expected mortgage stress as well. So particularly if we think about first home buyers, which is FHB here, and then investors, we see these two cohorts are more likely than average to be concerned about the cash rate increases occurring throughout the year. So particularly customers who are in the market for the first time, they've successfully bought a home, they've actually done this thing they were saving for, and now rates are rising rapidly. And in Australia, rates last year were at a record low. So you could have taken out a home loan and your repayments might have been, let's say, 500. Now they could be 1,000. And it's really that impact is potentially what customers didn't buffer for or they didn't expect. And typically customers will borrow to the absolute max. And it means that there is this potential that if they hit their maximum last year and now rates are rising, they may actually be thinking, can I afford to keep this home, or am I going to have to sell? Which is, incredibly stressful for someone who has managed to get their foot in the door and then is now thinking, have I made a mistake? Is this actually going to be viable? And what can I do to make sure I can keep this property and continue to live here? And then mortgage stress is part of this as well. And, we've got a very long-term trend here going back to 2009, with mortgage stress remaining quite flat. We did see quite a peak in the beginning of the COVID pandemic. So 1 in 4 saying they're expecting to struggle, though that did stabilise. And we did see Australian banks and lenders offering things such as home loan holidays. So you could have a couple of months off your repayments and just pay it later if you needed to, or defer those repayments, or customers extending their loan term if they needed to. But what we've seen in late 2021 and early 2022 is the expectation of struggling with repayments has increased, and it's now at 18%. So it's not quite at the levels of peak pandemic, early pandemic March 2020, but it is increasing consistently. And the reason for this, if we look at the bottom chart, is the rise in cost of living, higher grocery prices, and also the cost of mortgage repayments. So it's not just one of these, it's a combination of these. Most borrowers expecting mortgage stress selected at least 2 of these options, close to 3. So there's a number of reasons why customers are expecting to struggle, but it is typically that rising cost of living and the rising cost of groceries, plus the actual cost of the repayment themselves or itself. And like we saw with the strategies customers are making to try and save money, for those home loan customers who are expecting to struggle with their repayments, they're typically planning to cut daily expenses or cut non-essential or luxury expenses. So it's really about reducing personal expenses as a first strategy, and then thinking about, using offset funds or redraw funds or refinancing the product, or even, last resort, selling the property. It's really, can I just cut my personal expenses first? What can I do on my own lifestyle before I actually make changes to the home loan product, or actually think about selling or refinancing or downgrading? So that just seems to be the strategy at the moment. The first one is to really think about reducing personal expenses before, really dipping into the offset or the redraw or making changes to the home loan product itself. Then if we go back to the broader market, we know that across Australia, there was that low, 1 in 3 saying that they feel they're at an optimal level of financial wellness. And younger Australians are less likely to agree that they're at an optimal level, and they're also less likely to feel confident about managing their expenses or feeling able to manage their finances. And there's a few different options on this chart. So the chart's looking at customers across Australia, so agreement with statements such as, I'm able to pay my bills on time, I know when bills are coming up, I know how much money is coming in. You can see that agreement's around 40-50% here, and if you group together the strongly agree and somewhat agree, it's about 3 and 4 agreeing with these types of statements. However, in the red text here is customers aged 18 to 29, and you can see the difference between the strongly agree versus those aged 18 to 29 is quite significant. In some cases it's a 10% difference or more. So they're a lot less likely to agree they're able to pay their bills on time, they know how much money is coming in, they feel in control of their everyday spending. They're less likely to agree they feel confident or they're able to stay on track to meet their savings goals. There's a big difference here between the agreement of this age group with these financial management type statements and confidence statements. And I think this represents a real opportunity for financial institutions to think about, how can we support customers with managing their money, particularly knowing about the aspirations for home ownership, but also just thinking about financial stress more broadly. We know financial stress has health implications. We know that it has profound impacts on, relationships and family and various components. And, a lot of these are basically areas where customers can be stressed. So I don't know when my bills are, or I'm struggling to save money, or, I don't feel in control of my everyday spending. Some of this can be addressed with helping customers understand their financial position and helping them manage their expenses, so they feel confident and they they know what they're doing, and they know what decisions, the impact of different decisions as well. The other point to make here is that there is a very clear relationship when we look at the agreement with the statement, I'm at an optimal level of financial wellness, and the agreement with these different money management statements. So in the blue is customers who think they're at an optimal level. You can see they're a lot more likely to agree with all these statements. So they feel confident, they can pay their bills, they're good at creating budgets. Whereas those who disagree, so those who don't think they're at an optimal level of financial wellness, they're disagreeing across all of these statements. And I think that really just reinforces the need for extra support for customers, but also just opportunity to think about financial literacy, financial education, financial capability. How can you help customers, with these different components, understanding their own money, understanding their expenses and the bills that are coming up as well. And then the final couple of slides here is just thinking about, what do we need to do? What can we do to, or what can financial institutions do to help customers? And as mentioned in the beginning, savings goals include having a savings buffer and buying a home. So there's opportunities for banks to help consumers with these goals. And I think having a financial buffer and safety net is a particularly important one. As I mentioned, this came out of the pandemic as something that we've all realized is incredibly important, and a lot of customers had to learn the hard way that they just didn't have the unexpected expenses budget. It should be about 10% of your income, or at least a month's salary. So if your fridge breaks, if you need to any sort of medical expense or something like that, you could actually service it. And a lot of customers learned they just didn't have this. And we see in our research that this is remaining a consistent savings goal. So the key reason customers are saving money, and followed by that is travel and holiday and house deposit, though you can see travel and holiday was something that's only just starting to creep back up. Pre-pandemic, it used to be, again, one of the top 3, but in the pandemic, it wasn't as prevalent given none of us were allowed to travel. But then house deposits particularly resonating with a younger customer. So under 25s indicating they are saving for a home. But financial buffers, that's really in first place there and continues to be in that solid position as the top savings goal. And when we ask Australians, what could be helpful to help you manage your money right now? Across, especially for the younger customers, we see tools such as savings goal setting and tracking tools, or tips about how to control my spending, budgeting tools, those types of tools. We call them personal financial management tools, or PFM tools, typically offered within digital banking platforms. I think these types of goals are basically helping with the aspirational points, so helping customers save goals or set up goals for their savings so they can build towards something and feel that they're actually progressing towards a goal. But even something such as tips about how to control my spend, that speaks to a broader need for financial literacy, financial support. I think there's opportunity for banks and financial institutions to just think about how can you provide information that is digestible, it's accessible, I don't need to necessarily go out of my way to find it, but when I have questions, or when I want tips about spending or budgeting, or tips about how to maximize my savings, I can access this and I can find it, and it's in it's in language that I can understand. It's not full of jargon. It's not only for specific really savvy investors. It's for the everyday consumer. I think that's something that really comes out of this research. We know earning an extra interest on savings is appealing. Of course, that will be helpful because it's going to help you save money, but budgeting tools and tips about maximizing their savings coming out as quite important as well. So just to summarize, I think some of the key points here is really that financial wellness is something that we know relates to financial stability and comfort, though we only see 1 in 3 Australians strongly agreeing with this. So it does suggest there's opportunity for this to be addressed, at least in the Australian market, but I also would be fairly confident to say that this would relate to other markets as well when you look at similar metrics. And consumer sentiment is sensitive. It's influenced by both national and global factors, and we see that customers are feeling less optimistic than they were in previous years. So that adds to the financial stress, and there is concerns about rising cost of living, rising interest rates on customers who have a home loan, and expectations of stress with meeting those repayments as well. And the strategies that Australians are taking is just trying to save as much money as they can, but also reducing non-essential spend. So I think the real opportunity for financial institutions to keep in mind is how can they help Australians understand the importance of maintaining a financial buffer? What should that dollar value be? Are there tools that they can use to help customers calculate this and think about, what are some realistic expenses that could actually come up that I need to buffer for, as well as tools for managing expenses. There's opportunity for proactive communication as well, reaching out to customers, making sure that they know what to do if they have questions, making sure the customer service is approachable. Then also, particularly for the younger cohort, thinking about tailored digital apps and digital tools that can actually help customers understand their financial position, relate to the data, have a look at their situation, and use particular tools and AI to actually do things such as forecasting when their next bill payment is, or tracking savings and spending, or setting up ways to progress towards savings goals that are kind of positive and help customers feel that they're working towards something that they can actually achieve. So that comes to the end of my presentation today. I'll stop sharing my screen now so we can go back here. But I think that just speaks to the landscape in Australia and the importance of thinking about how customers are feeling at the moment, the stress they're experiencing, the concerns they have for the next couple of months, but also the year ahead, because we think about we're getting close to the end of the year, there's Christmas, there's new expenses, and now next year, who knows what that landscape could look like. So it's really thinking about what support is needed and what do we need to be thinking about when addressing and approaching financial wellness strategies.
That's fantastic. Thank you so much, Anna. That has been so interesting. As a researcher, my heart is always in what does the data and the evidence tell us? And in many ways, I can see the picture that you're painting of uncertainty, of unstable finances, and the fears that brings. And as at heart, I'm an educator. So what I'd like to say to people is that all of the data that you presented is true. This is the context that we're in. But the good news that I'd like you to go away with today is there are things that you can do to control. Yes, so I always try and bring back that element of there are personal things that one can do to control. And the thing that I'm absolutely passionate about is another definition, but I'll put it in anyways. It's called financial resilience, the ability to be able to recover from a shock. So I think that that is the heart of everything that you've talked about today. How can our consumers be prepared to recover from a shock? We don't know when it'll happen. We don't know who it'll happen to, but there are things and strategies that we can do to take whatever little control we can. And one of the things that you've talked about is absolutely crucial, which is a savings buffer. Having a savings buffer is one of the few things that can really help you to recover from a shock, no matter where that comes to you, later in life through a relationship breakdown, or very early in life as a young person who loses their job, or many of the life events that happen that you have no control over. So the difference you've also talked about that income makes, recognizing that even though income is not something which is directly in your control always, having that little bit of a buffer, even if you're on a low income, it protects you from the consequences of making a wrong decision. Because any one of us can make a wrong decision. But when you're on a higher income, the consequences are lower because you have a buffer to fall back on. Whereas the same person who has a lower income makes a mistake in their finances, the consequences are more severe because they don't have a buffer. So having a savings buffer is one of the best ways of ensuring resilience. You've also talked about, from an education point of view, many of the things that your consumers are pointing out as tips as to what they would like or what they're already doing. And as an educator, it really, in many ways, pleases my heart that after 20 years of constantly talking about the same things, our consumers are now using those hints and tips. Reduce your everyday expense. Use a tool to help you to balance money in, money out. Have whatever little savings you can put away, create that habit of a savings. These are the little things that everyone can do, no matter what their age and no matter what their income level, in order to try and get towards financial resilience. And the last thing I'd really like to say is that, it is in the interest of not just the financial institutions, but also the utility providers, and in fact, all of the people whom we purchase products from, to care about consumers who are facing financial hardship. Because by helping those consumers and proactively helping them to recover from a shock that is building resilience, it's good not just for the consumer, but also for the organization, because then the consumer will be able to repay instead of you having to write off the debt, or buy more of your product instead of reducing their spend. Yes. So for anyone who's listening today, I'd really like to highlight three things. One, please be conscious that we have worked for a very long time with the financial institutions, the utility providers, and now a growing number of retailers as well, to recognize the importance of helping those who are in financial hardship. So should you feel that you are in a position that you require help, please don't hesitate from reaching out to your bank, to your utility provider, even to your retailer like a Coles or a Woolworths, to let them know that you're in hardship and that you would like some help. And they are bound by obligation now to offer you assistance. I'd also like to point out the National Debt Helpline. It's a free helpline. Please reach out to it. It's 1300 007 007. You can't forget it because it's the James Bond number. And if you ring the National Debt Helpline, they can talk you through many of the simple things that you can be helped with, or put you through to financial counseling, which is a free service offered in Australia. So at the end of the day, I'd like to say I don't want to wish away the fact that there is uncertainty, there is instability, and all of us are facing it, no matter where we are on a life stage or no matter where we are on our income level. But the good news is that behaviors are the key determinant of financial well-being, not just income. And behaviors are in everyone's control. So I'd like to finish today by saying, if you want to build your confidence, if you want to build your sense of control and stability, there are ways that you can do that, even if you're on a low income. So please don't give up hope. Have hope that there are ways in which you can build your financial resilience. And of course, please always feel free to reach out to those who know who can support you, such as our wonderful friends at RFI. So thank you so much, Anna, for your really evidence-based discussion today. I am so pleased that this is a wonderful way to share hints and tips with the rest of the audience as well. So thanks again to everyone, and to RFI and Anna.
Thanks very much. Thanks, everyone.
Thank you.